Welcome video. What if I told you that you could bypass the traditional banking system and still get the funds you need, or even earn money from lending directly to others? Sounds unbelievable, right? But it's happening right now. Welcome to the exciting world of peer-to-peer P2P lending, where anyone can borrow or lend money without going through a bank, and the financial landscape is forever changed. Before we get started, make sure to hit that subscribe button to stay updated with the latest trends in finance. We're so close to reaching 1,000 subscribers, and your support helps us keep bringing content like this your way. Let's dive in. Peer-to-peer lending, often referred to as P2P lending, has emerged as a revolutionary concept in the world of finance. Traditionally, if you wanted to borrow money, you had to go through a bank, undergo a lengthy approval process, and of course, pay hefty interest rates. On the other hand, if you wanted to invest your money, you'd often have limited options, with traditional banks and financial institutions offering relatively low returns. But in recent years, a new and exciting alternative has emerged: peer-to-peer lending. In essence, P2P lending is a financial system that connects borrowers directly with individual lenders through an online platform. This model eliminates the need for traditional intermediaries like banks, resulting in lower interest rates for borrowers and better returns for investors. It's a win-win situation for both sides, and it's shaking up the financial industry in a way that few other innovations have. The concept first gained traction in the early 2000s when platforms like Lending Club and Prosper launched and quickly became popular. Fast forward to today, and P2P lending has grown into a multi-billion-dollar industry with a significant presence in the USA. The rise of these platforms has created a new financial ecosystem, giving more people access to the capital they need while also providing better investment opportunities for those looking to diversify their portfolios. So why has P2P lending become so popular? The primary reason lies in its accessibility and efficiency. For borrowers, it offers a faster, simpler way to secure loans, often with lower interest rates compared to banks. Many P2P lending platforms also allow borrowers to apply for loans without the lengthy approval processes that are common with traditional banks. As long as you meet certain eligibility criteria, you can get funding quickly, which is a huge advantage, especially in today's fast-paced world. For investors, P2P lending offers an opportunity to earn higher returns than traditional savings accounts, bonds, or even stocks. Since P2P platforms cut out the middleman, the returns on loans are typically much better than what you would get from a bank. Investors can also diversify their portfolios by lending small amounts to a wide variety of borrowers, spreading out the risk and increasing the chances of earning consistent returns. But the rise of P2P lending hasn't come without its challenges. There are inherent risks for both borrowers and lenders. For borrowers, while the interest rates are lower than traditional banks, default risk remains a concern. If you fail to repay your loan, it could have serious consequences for your credit score and future borrowing ability. On the flip side, investors face the risk of loan defaults, where borrowers fail to repay their loans. In such cases, investors may lose the money they've lent out. To mitigate these risks, P2P lending platforms use advanced algorithms and credit scoring models to evaluate the creditworthiness of borrowers. These tools help ensure that only borrowers with a reasonable chance of repayment are approved for loans, reducing the likelihood of defaults. Additionally, many platforms allow investors to diversify their investments across a wide range of loans, reducing the risk of losing all their money if a single borrower defaults. As P2P lending continues to grow, it's also starting to evolve in interesting ways. Some platforms have introduced automated investing tools, which allow investors to set specific criteria for loans they want to fund. This takes much of the guesswork out of investing and makes it easier for individuals to get started with P2P lending. Some platforms even allow investors to choose loans based on social impact, such as funding loans for environmentally conscious projects or socially responsible businesses. The COVID-19 pandemic also had a significant impact on the P2P lending market. With traditional banks tightening their lending standards during the economic downturn, many borrowers turned to P2P platforms for the capital they needed. At the same time, investors seeking better returns in a low interest rate environment flocked to P2P lending as a viable option. In fact, some of the leading P2P platforms saw record-breaking loan volumes during the pandemic, as both borrowers and lenders sought alternative solutions. While P2P lending offers a variety of advantages, it's important to note that it isn't without its regulatory hurdles. The industry is still relatively new, and government regulations surrounding P2P lending are still evolving. Some experts believe that increased regulation could help protect both borrowers and investors, while others fear that too much regulation could stifle innovation and growth in the sector. One of the key areas of concern is consumer protection. In traditional banking, there are a range of regulations designed to protect consumers, including laws governing loan terms, interest rates, and disclosures. While P2P lending platforms are required to adhere to certain regulations, they don't always offer the same level of consumer protection as traditional financial institutions. This is something that both borrowers and lenders need to be aware of before getting involved. Looking to the future, P2P lending is expected to continue its upward trajectory, particularly in the wake of the global shift towards digital financial services. As more and more people turn to online platforms for their financial needs, P2P lending is likely to become an even more integral part of the financial ecosystem. The rise of blockchain technology and smart contracts could also play a role in enhancing the security and transparency of P2P lending platforms, making them even more attractive to investors and borrowers alike. At the same time, the increasing use of artificial intelligence, AI, and machine learning in the industry will likely lead to even more efficient and personalized lending experiences. AI-powered credit scoring models, for example, could provide a more accurate picture of a borrower's creditworthiness, further reducing the risk for investors. As the P2P lending market matures, we can also expect to see new types of platforms emerging. Some may focus on niche markets, such as lending to small businesses, while others may offer innovative loan products, such as income share agreements, which allow borrowers to repay loans based on their future earnings. The possibilities are endless, and the future of P2P lending looks brighter than ever. As we wrap up today's discussion, I encourage you to take a closer look at the world of peer-to-peer lending. Whether you're looking for a more accessible way to borrow money or hoping to earn better returns on your investments, P2P lending offers a host of exciting opportunities. But, as with any investment, be sure to do your research and understand the risks before diving in. And before you go, don't forget to subscribe to our channel. We're so close to reaching 1,000 subscribers, and your support helps us bring you even more content on the latest trends in finance and investing.